Shalom to the elect of Israel, to the hopeful elect of Israel, you Hebrew Israelites, you so-called Negroes, Latinos, Native Americans, West Indian, and Haitians. Gotta give all praise, honor, and glory to Yahweh, Bahashim, Yahweh Shai, Bahashim, Rakah, Korash. Give honors to the apostles and elders of Great Millstone who rule well, who teach well, and a sincere salutation to all the Akim pushing the truth and believing the truth throughout the four winds of the earth, the entire world, waking up the hopeful elect. Shalom to the Awaf who are listening and learning, the few sisters who are listening and learning. I'm Isaiah, coming at you with another lesson in truth, facts, faith, and edification. Another daily edification, the Lord is willing to be edified. And this is an update, a new report on Babylon the Great, sitting in the dust. Another economic downsizing report of the virgin daughter of Babylon, North America, and their debt. Lord's willing to be edified.
President Trump is a big fan of low interest rates.
Frankly, if we ever got interest rates down where they should be, and if they weren't raised so fast, you would see another probably 10,000 points on the down. The Fed acted too soon. I turned out to be right. They acted too soon and too violently. The Fed moved, in my opinion, far too early and far too severely. It puts me at a somewhat of a disadvantage. We'll see what happens with the Federal Reserve, whether or not they finally get smart and reduce interest rates like many other places around the world that we have to compete with. Because if you look at what the other Fed equivalents are doing all around the world, they're at a much lower rate, and it makes us harder to compete.
Recently, Trump even went so far as to praise Germany's 0% interest rate.
In Germany, they have zero interest rate. And when they borrow money, I mean, when you look at what happens, look at what's going on over there. They borrow money, they actually get paid to borrow money. And we have to compete with that.
Then, he went even further on Twitter, referring to the Fed as, quote, boneheads. But what if Trump got what he wished for? What if interest rates were actually zero, or negative like Sweden or Japan? What if instead of a bank paying you to hold your money, you theoretically had to pay the bank to keep it there? It could happen with negative interest rates. Negative interest rates first appeared in 2009, when Sweden cut its rate to negative 0.25%. The move was meant to provide a short-term jolt that would stimulate a stagnant economy and encourage banks to lend, since holding on to money meant financial institutions would have to pay interest to Sweden's central bank. But there was a fear the move could also impact savers, who could be charged by the banks holding their money. Economists feared savers would hoard cash rather than pay the bank to hold it. But that's not what happened. Instead, Swedish savers spent or left it there. That's not surprising, since Sweden has one of the higher savings rates in the developed world, according to the Organization for Economic Cooperation and Development. Since then, central banks in Denmark, Switzerland, Germany, Japan, even the ECB have followed suit, taking rates into negative territory.
Wow.
So what exactly are negative interest rates? Interest rates are generally thought of as the cost of borrowing money. Central banks raise interest rates to cool off an economy that's close to overheating. Zero or negative interest rates, on the other hand, are seen as a way to stimulate an economy. In theory, negative rates force banks to lend more, but it doesn't always work that way. Instead, negative rates can actually have the opposite effect. They can squeeze profits so much that financial institutions actually lend less. They can also have an impact on government funding. For example, Germany's economy is on the verge of a recession, so it's lowered interest rates to negative 0.31%, which means investors could be charged for keeping their money in the bank. But the country still needs to fund the government. So in August 2019, Germany attempted to sell 2 billion euros worth of 30-year bonds, which would mature in 2050, and they had a negative yield. As a result, investors only bought 869 million euros worth, with a yield of negative 0.11%. In other words, investors will, in theory, pay to have the German government hold their money.
Anybody who holds this bond throughout its full life is guaranteed to lose money, and they're guaranteed to lose money over a period of 30 years. Now, what this is telling us really is that anybody who thinks that this is a good investment is factoring in an extremely bleak economic outlook. You're talking about no growth, no inflation for the next 3 decades.
In the end, the German government was forced to buy the remaining bonds itself, which could push down interest rates even further. At the same time, the European Central Bank, or ECB, has continued on its own negative rate path. The ECB recently lowered its main deposit rate to negative 0.5%, a 10 basis point cut. It also reintroduced quantitative easing as a means to try to stimulate the economy. Negative yields and low interest rates in Europe have also had another effect. They've driven investors to the US bond market in search of safer investments with a yield. Negative rates cause uncertainty in the markets. Many experts believe negative rates in Europe have only had a modest impact on Europe's growth. While it lowered the cost to borrow money, it didn't do anything to increase demand for goods. As a result, businesses didn't invest. Lowering rates even further could put the entire global financial system at risk. Negative rates cause a decrease in margins, which decreases profitability for banks. And that can cause a bump in fees for loans, including home mortgages. They also make it more difficult for a country's institutional investors to find appropriate opportunities for clients. If markets shift, bondholders seeking gains in price rather than yield could get stuck holding too much risk. Germany's negative interest rates have dramatically pushed up prices. Recently, traders paid the equivalent of $195.87 for every $100 in 20-year German bonds, which translates into a technical negative yield of 0.386%.
Wow.
Former Fed Chief Alan Greenspan has said that he doesn't believe negative interest rates in the US would be that big of a deal. But others disagree, saying negative rates can be a trap, that they may not boost flagging economies, and can even become the norm. And that hurts banks, savers, and companies in the long run.
It is the financial sector, the banks, the insurance companies, the pensions, the security settlement is all structured, invented on one assumption: positive interest rates.
Marginal reserves?
Yeah, marginal reserves. Everything is on positive interest rates. You take those away, and now the investment decision loses you money in a negative interest rate world. The banking system doesn't work. Pensions
How
don't
does the
work.
European system work? They're doing a little fudging, aren't they? Some creative movements you were telling me about?
Yeah, the European system works because we, the reserve currency, are still positive. Banks like Deutsche Bank are restructuring their entire worldwide reserve system to invest in US dollars because they've got positive yields. If we go down that road and go negative yields with them and cut everybody off from positive, I think the financial system is at severe stress then at that point.
There's also a concern that negative rates encourage governments to borrow more without concern for growing debt until the rates go up and the bill comes due. Meanwhile, trade wars have taken their toll on the global economy. And there's a growing concern because rates are so low now, the next recession could force the Fed's hand. Then, negative rates could be the only alternative. Larry Summers, former Treasury Secretary under President Bill Clinton, says that once rates go negative, it could be extremely difficult to get out, and the global financial system could get stuck.
And I think the great concern is with what I've called the monetary black hole, that zero rates appear to be where we're stuck in Europe and Japan, and we're one recession away from a situation of that kind. And it's a very different world when everyone's stuck at zero interest rates. We're going to have to think about stabilization policy. Institutions are going to have to think about their investment policy in a very different world, in a very different way when we have black hole, zero interest rate world, and that's what I fear we're headed into.
And Morgan Stanley CFO Jonathan Pruzan agrees, saying that negative rates provide little relief.
Clearly, the negative rates have not really been helpful to spur the economy in some of these markets, and we'll have to just see how it plays out. But this negative rate dynamic continues to have investors searching for yield, and I think that's a trend that's going to continue because not only are there a lot of negative rates, if you look at the stack of debt products out there, there is not that much inventory that's yielding over 5%. So on the one hand, you have a lot of negative rates, and on the other hand, not a lot of places where you can find yield.
And that's why Harvard professor of economics Ken Rogoff believes negative rates will eventually make their way to the United States. But he also says there are more challenges involved for the U.S. than just the rates themselves.
I think eventually it will come here to the United States. It may happen sooner rather than later. However, the United States beyond the Federal Reserve, the government would have to take a lot of steps in changing tax laws, regulatory laws, and particularly how to deal with cash hoarding to really have negative rates dip very far.
So Trump may get his wish of zero or negative rates, but the economic slowdown that led to them would dampen the president's prospects of re-election, and the end result could be even worse for the U.S. economy.
Well, I am terrified if we go negative rates in the United States. It will virtually destroy the banking system as it is doing in Europe as we speak. And that would be a major, major crisis.
I continue to think there'll be consequences, in the long term for negative rates as an experiment. I certainly hope in the U.S. there's never a consideration.
This devil named David Solomon. You gotta be kidding me, man. David Solomon. Wow.
Of negative
These
rate
devils,
policy
man.
here in the U.S. I think it's interesting to see where we are in the economic cycle, where we are from a job perspective, and just balance the policy.
Hey, you see how they parents, these people parents were trying to get them the name of our ancestors, man. David Solomon.
That we have today. Personally, I'm not a Fed governor, but personally, I've been surprised still by the amount of monetary policy or kind of the low rate environment that we still have at this point in the cycle. I would have expected something slightly different, but negative rates are not something that I think would, when we look back on history and write the book on that, I'm not sure that'll be a good chapter.
Hey, man. They going down, man. They going down.
My pleasure. Another economist considered one of the world's smartest guys is coming out with bad news. This guy's name is Nouriel Roubini. Nouriel Roubini. He's a Turkish immigrant who's considered one of America's foremost economic minds, who was the #2 man in the Department of Treasury under President Bill Clinton. He has just announced, a couple of hours ago, by the way, when this crossed, that according to him, the global recession is already underway. That's what he's saying. And he's warning central banks all over the world not to try and get out of it by simply printing more money as they have in the past. This is a sentiment echoed just yesterday by the aforementioned, in my conversation with Dr. Wolf, Ray Dalio, right? So here you have these two guys, prolific, famous, well-known, saying kind of the same thing. So what gives, right? Why are we suddenly hearing this from so many people? There's one guy, one person who's been making that argument now for years, and he's been called everything from a kook to a rabble-rouser for saying that very thing. Former Congressman Ron Paul has been screaming it from the mountaintop. The Fed and central bankers, he has long said, are the problem. Joining us now, there he is, none other than Dr. Ron Paul. This is interesting, isn't it, to hear a guy like Roubini essentially saying the things that you have been saying. If we keep printing more money, whatever recession comes will be worse. You agree, I imagine, right?
Yeah, certainly, but it seemed like they were still blaming too much capitalism, too much freedom, and it hasn't worked out. We have to have something else. But I think this is all explainable. It was predictable by Austrian economists over the years that if you destroy the middle class, or if you destroy the currency, you destroy the middle class, and that's what's happened. We've accommodated many people who wanted help, a lot of welfareism, corporate as well as individual welfareism. We've done that at the expense of running up debt. And when you do that, you have to borrow money, and the very people you're trying to help, the poor, they suffer. They end up getting the inflation. So this is a predictable event, and this pretense that debt has been okay because it's been helping people. All you have to look at the world today, $188 trillion of world debt. And it's supposed to help people, but it's not helping people because it's not the market. It's Keynesian economics. It's not sound money. It's not the gold standard. It's zero rate interest rates and negative interest.
Now you heard Ron Paul say 188 trillion. But when you punch up the debt clock on Google, it tell you that it's only $22 trillion in debt North America is. You see? But then you got other economists that say it's over $300 trillion in debt. So these devils, man, they are the forges of lies, man. Job 13:4, man, they are the forges of lies, man.
Rates, and there's a dependency on government to solve all these problems when government has been at fault and have created these problems.
The Fed aside, let me take issue with you, Dr. Paul. Suppose you're right. Suppose the best thing we can do is allow people to start businesses and let the market rule. But what happens when those people become so big that they're able to essentially manifest the government, control the government, buy the politicians? Isn't that even worse?
Yeah, there's a problem with the politician who sells out. You don't have that. But you have to distinguish getting rich and powerful and influential from doing it by earning it and providing a service or a product for the people who voted them this economic authority. But if they if they get their power because they're connected to the government, which is essentially all the powerhouses, the banking industry, the military-industrial complex, the social media has had advantages from the government. That's wrong, and you can't allow that to happen. But if you have a company that provides a service or a computer that everybody likes and they vote you rich, and you haven't had any benefits from the government, you should applaud them. But nobody does. Anybody who's rich is bad, and that's what's going on right now, because a lot of them got rich because they were in bed with the government. They're partners with the government. All you have to do is go around Washington, D.C. You ought to see where the big houses are. They're with the lobbyists. But if you had a limited government, there'd be no incentive to have lobbyists. When I was in Congress, the lobbyists never came to see me, because my vote wasn't for sale. But it's a system that is very bad. They've been rewarded. Businesses are rewarded, and they figure that's the only way they can go. And what we need is honesty in government. That is honest monies, balanced budget, follow the law, don't get in wars that aren't authorized, and all of a sudden it would be a different world. But just because they're big and it looks like they're influencing the government, which is true, that's secondary. That you're looking at the symptom. The real problem is the acceptance of the role of government to manage our lives, manage the economy, policing the world, and telling people what to do. That's where the problem is. You need a lot of bureaucrats to do that.
I need you, before you go, to at least address the central bank issue. Central banks all over the world right now are either printing money or dropping interest rates. It seems to me that that's a foolish errand. You say what?
Well, it's a terrible idea, but it's a logical consequence of steadily lowering interest rates and not to having the courage and wisdom of stopping that and let the market determine interest rates. So, no, this is natural, because if you stop, there's a lot of painful suffering from that. There's an addiction out there. But the big problem is the debt. Nobody pays attention to that. So when people run into trouble, and all the countries are running into trouble, and then we run into spending more money and run up our debt and think we're going to solve the problem, and then print it to solve the problem. It won't work.
Unbelievable. Dr. Ron Paul, always a pleasure to have you on. Thank you, sir, for coming on and sharing your perspective with us on this very important story that everybody suddenly seems to be talking about. My thanks.
And there it is, man.
Out a statement tonight saying that debt is threatening global economic stability. In countries with advanced economies, public debt is at levels not seen since, get this, since World War II, right? While emerging markets, public debt is at levels not seen since the 1980s. In the United States, we've reported this. The public debt is at $23 trillion. Why is the debt so high everywhere? Free money. Seems ironic, but
the debt is over 300 trillion, man.
The worse economies get, the more central banks reduce interest rates, for example. The more they reduce interest rates, right? You don't have to be a world-class economist to follow this pantomime, right? The more they reduce interest rates, the more we borrow. The more big companies borrow. See, eventually that bubble, almost by definition, has to burst. Then what? Joining us now is John Grace. He's the founder and the president at Investors Advantage Corp. Mr. Grace, it's nice to see you. Thanks for being with us. I'm going to read to you what Ray Dalio, who, by the way, owns the biggest hedge fund in the world, says. He says, the world has gone mad. Quote, the system is broken. And trickle down, it doesn't work. You say what?
I say, Rick, Ray is right on. He's called it. And he certainly has a big megaphone to make his points. and is one of those things that most of us don't recognize. But if you look at, everybody's playing the same game, right? Greed is good. Greed is fantastic as long as you get over. When we look at the consumers, their debt level is the highest it's ever been. Same with companies as well as governments. At some point, the music on the carousel is going to stop, and it won't be fun when it does.
It's interesting because he's putting the blame on central banks, not just ours, but central banks all over the world. He says that this free money that's being printed by the central banks are essentially forcefully flushing into the economies. And here's the point, at least this is an argument, interestingly enough, I was having in my own dinner table this week with my family. It's happening without sustainable growth, right? It's not happening because EBITDAs are big. It's not happening because P&Ls are impressive. It's happening because people are borrowing money, right?
Well, this is so true, and I think this is how Wall Street has managed to manipulate Main Street. And as I say, the debt levels are the highest as they've ever been. And when you get free money, sometimes you do some smart things, sometimes you do some really stupid things. But we all know if you can't make those series of payments for whatever reason, as I say, then the music stops and now you have a brand new reality. So I think Ray's called it.
Are you a...
Listen, man. Hey, Elder Apostle Tahar always say, man, watch these economists, man. Okay? And these is top men. And I ain't even did a lesson. Listen, I haven't even thrown in Peter Schiff and Gerald Celente, man. Okay? Peter Schiff and Gerald Celente, you know, but they just some videos I was checking out, man. Hey, the Elder Apostle Tahar always say, watch these economists, man. Cause they tell you what's really going on with Babylon the Great and the collapse of their monetary system, man. Okay? You people better pay attention to what's really going on, man.
Among those who believe that given these conditions that you and I were just describing, it's almost inevitable that sometime in probably 2020, we're going to be faced by some kind of downturn,
Facts.
Possibly recession, possibly a severe recession.
Yeah, I got a lesson on Peter Schiff and Gerald Celente coming too. Lord willing, I'll do that tomorrow. Lord willing.
People have even used the D word and said depression. You say what?
I say be prepared for all of the above. You know, because it's never the bus you see that you...
And see, it all boils down to this, man. They got to crash the dollar so they can bring in the RFID microchip, man. Okay? They got to crash the dollar. That's what this is about, man. Crashing the dollar to create that one world currency, man. That's the whole goal. That's their main agenda, to crash the dollar and bring in the RFID microchip, man. They want to make everything digital, man. North America, Babylon the Great, is the only country that's not 100% digital, man.
Disrupts your day. It's the bus you did not see, you did not name, and maybe you got the license plate if you were able to get off the ground. So don't, and when it comes to a recession, how do we know when it happens? What is it, 2 negative quarters back to back? Well, that means you only see it in your rearview mirror. So
right.
Who's going to call this? No one has called it really adequately the last 2 times, 02, 08, 09. What makes you think that somebody's going to call it the next time? Be ready for it. And I like to use the analogy, people like football. And you don't have to be a football real fan to recognize that you have 11 players on offense and 11 players on defense. Most of us have our portfolios oriented all on offense, where we're trying to make money, all trees grow to the sky.
Right.
And most of us do not have any kind of strategies or ways of recognizing where's the exit clause. How do I keep my account intact as opposed to watch it go down like the Titanic?
Why is it that Ray Dalio gets it? You obviously get it. I think most Americans even get it because they've all had to budget their own households and understand that you can't come up with something you don't have and aren't going to make, right? So why is it that Democrats and Republicans don't get that? Because Barack Obama was just as guilty. I mean, he essentially allowed the Fed to print money. You could argue on his behalf that at least we were in some pretty severe economic times when he was doing that. But this guy in the White House now, Mr. Trump, he's doing the same thing while at the same time saying we have a great economy. So they all do it. Why?
Well, this is true. Only that, this guy has kicked it up to a new high. And remember, he said he was the debt king, right? So he likes debt, and when you have appreciating assets, debt is an asset. But
Hey,
when things are in
Babylon is
decline,
done,
debt
man.
becomes a sudden liability. So he's used to all of the upsides, and he's thinking that he's going to buy his way to stay in the White House. That may or may not prove to be true. But as I say, no one knows what's going to happen. But you don't have to have the right prediction to do the kind of preparation you need to do, so that you can assess in advance what kind of loss can you live with, and then how can your portfolio be set up in such a way where you can have losses that are manageable to you. That's a personal question. It's not as easy as are you conservative, moderate, or aggressive.
There are people who are frequent guests on this particular newscast, like David Stockman, for example, who was the budget director of President Reagan. I'm sure you know of David Stockman. Colorful guy. He's essentially telling people, get the hell out of the market. That's just not a good place to be, and it's going nowhere. Do you agree?
No, I want all of the upside.
IMF estimates global debt reached 188 trillion.
For a meltdown. So
And
I'm
that's
not
a
trying
lot.
to get people out yet. I do want them to be prepared so that they can see the portfolio's going to
It's
stay intact.
388
That way they don't have to
trillion.
worry about what the market does.
It's all about finding out where that trigger is, though, and being able to call it. And I guess that's what makes guys like you so good at what you do. Thank you so much. Great conversation. I really enjoyed it and look forward to talking to you again.
Hey, man. Babylon the Great, man, is coming down, man. Okay?
Show on Monday, and of course you did. You might remember
Six
that
scenarios.
Carter was sounding the alarm that an October sell-off could be on the way. Here's what he saw in the charts.
In this scenario, we are down hard here in October. We're backing and filling a bit in November, and then we plunge again as low as 2,400 and have a few weeks of strength ending at 2,650. Now keep in mind, to get down to 2,400, that'd be about a 19% sell-off.
Despite today's comeback, stocks are still down big this month. So where are we headed next? Carter, why don't you head over to the plasma? Break
A
it down.
lot of guesswork. Let's go do some guessing and some analyzing and see what we can come up with. But obviously slippery. People, I think, have been hurt, and then perhaps a little oversold and a little bit of a bounce. But all to what end? So, chart of the S&P, no judgments, annotations by me. Let's put in some lines. One thing to look at. 3 distinct sell-offs. 1, 2, 3. What percentages are they? The first one, down 7.6, down 6.8, down 5.5. How about the duration of the sell-offs? 22 days, 14 days, 15 days. So a lot of things. But here's the thing that's maybe a little bit worse about this one, in that we did not make a new high. That is a bit of a problem. This was an incremental new high, but really what this was a failure to make a new high. So let's draw some lines. We've broken trend, and interestingly, today's kickback went right to that trend line and stopped. And then, if you put in our flat top, there it is. Not a great setup. Again, I think the bias is to the downside, and that what we've seen in terms of trouble is just the precursor to more trouble.
All right, Carter, why don't you come on back?
I thought there were 6 scenarios on Monday that he talked about.
You thought that on Monday as well, and you're wrong today. It's on Monday, because there aren't 6.
Sweet laugh track. So, so what I look, you have to.
It's all fun and games right now,
what
man.
Carter's talking about. Think about Apple, which didn't make that new high. Think about J.P. Morgan, which maybe but really didn't hold that new high. Think about Home Depot. So we're talking about very, very popular crowded trades that certainly people have been able to have some justification on valuation and certainly some rotation element. And
The grinding is ceasing, man.
Disappointing moves.
The grinding is
Also
ceasing,
falls
man.
into that,
Yeah, I mean, and again, these are also crowded trades, right? Because they've been working. So you see a lot of people in the same names, and now all of a sudden things are starting to break down. So
And what Obadiah 1:7 say? There is no understanding in him, man. They can't even see that their system, their economy is collapsing, man. They can't even see it, man, because the Spirit of the Lord have them in blindness, man.
you don't have to have your bear suit on. You don't have to say the world's coming to the end.
but you can also recognize that, wait a second, maybe it's not as easy as it was before. We don't know what the economy is going to do. The odds of us getting a trade deal, I think, are lower than they have ever been over the last year or so. So there's a lot of things out there that you just don't need to buy stocks today.
Hey, Yahweh is making Esau bear, man.
Down below, where's the next stop? I didn't see where.
Jeremiah 49 and 10, man.
But there are reference
He's making
points.
them bear.
The June 3rd low. That's another 3-4%. And then there's an unfilled gap a bit lower than that. So I think those are in play. I guess the real issue is this, and this is independent of the charts. I mean,
I'm sorry, Carter. What is the June 3rd? Is it 28.15 or something?
Yeah,
like that?
28,
Okay.
and then a little bit lower than that. But the issue is, for markets to go higher, it's one of two things, right? It is either multiple expansion or it is earnings growth. And that, at the end of the day, is the bottom line. Which of those, or is it a little bit of both of those, is actually going to happen, and why?
Right.
So anyone can make a case for either of those right here? Multiple expansion?
Okay, can't.
Okay, there's one.
Rhetorical questions he's asking, Mel.
I
You know the answer in Carter's mind. We've been in a range for a long time. There's a lot of ammunition for both sides, and frankly, the glass half full is we've digested an enormous amount of headwinds that if we actually get some solutions here and some clarity even on where the Fed is going, and we get some earnings that give some more clarity into all these CEOs who are either making or not making these investment decisions in their business, the markets have been sideways. Let's be clear.
Last question, Carter, and that is, I mean, does it make a difference that expectations going to earnings are so low, that expectations for a lot of things have been ratcheted lower, and so therefore, you know, the ability to beat is much greater and bring the markets higher?
I think consensus for a decline by 3.7%, and that would be the third year-over-year quarterly decline in a row. That's, you can say, is the bar so low we beat that?
Yeah.
I don't know. So far, the things that we've heard have not been very encouraging. There's not been a lot of beats, and the ones that have beat have been tepid in terms of their price action.
Like would you say Nike?
Like Nike. I mean, Nike hardly broke out, whereas the ones that have collapsed, like FedEx and Carnival Cruise, have been a disaster.
Fresh new lows for FedEx today, by the way.
You see, man?
Officially on, apparently, Canaccord Genuity's Tony Dwyer says the clock is now ticking. Look at that clock. Ticking. On a recession and the market peak. 24 months, 0 days, 7...
You see that? They got a doomsday clock before the next recession hit, man. And you people out here playing damn games, man.
This is about 19 months. That's how we calculate it. But Tony says the market will rally more than 15% until the recession kicks in. He's over at the Plasma to chart it out. Tony.
Well, thanks, Mel. You know, Wall Street's filled with strategists that tell you something, they come on, and when it actually gets there, they change. And I'm not going to be that guy. I don't think it's different this time. What you notice on this chart is all those gray shaded areas are recessions. What happens every single time prior to a recession? Sure enough, you get a yield curve inversion of the 210. Okay, this one was a 39% rally prior to recession. This one led to this was 34% rally before the recession and the peak of the market. This was 39%, and this was 29%. So I think we're going to go actually a lot more than 15%. I think we'll do 15% in the next year, but it actually takes about 2 years. If you look at the last 3 cycles, the average gain has been 34%. The median gain has been 34% over 22 months. How do you know then, when is it time? Like, these numbers are great. Who cares about a median? How do you know it's time to get really defensive? It's time to get defensive when corporate credit really starts to act poorly. What you'll see here is prior to the recession, you had a bottom in the Moody's BAA. This is the lowest level of investment grade bonds. This is the average yield of those lowest level of investment grade bonds. It made a low 2 years before you went into a recession. We just made a record low. It was a record low. It was the only second time in the history of the Moody's BAA index since 1962 that the 10-week rate of change dropped to minus 15. That's not signaling that money is shutting down. Money shutting down is what causes a recession. And then lastly, the Fed, stunningly, the Fed is yet to get really ahead of the market. How do you know when it's ahead of the market? I believe they will, which is one of the reasons I still think the market's going to go up. How do you know they're not ahead of the market? Because this is the current lower bound of the Fed funds rate, and these are the 2- and 10-year note yields. Like, I don't need to be a master economist, because I'm not, to know that the Fed is behind the market when you're 50 basis points below the Fed funds.
Hey, man. Yeah, this place is done, man. This place is done, man.
Against the idea that you can grow your way out of a deficit. What does history tell us?
Well, it's voodoo economics. Reagan tried it, Bush tried it, and this time around, look at the latest number. The deficit since last year has already in August doubled. And it's going to double because you have a $2 trillion budget deficit. Next year, we're going to have a budget deficit that's going to be overall $1 trillion, the deficit. We're going to add to the public debt $1 trillion per year for the, as far as the eye can see. So it's totally voodoo economics. Of course, you cut taxes. There is some short-term improvement in growth, but it's going to be minimal. The CBO estimates over a decade 0.1% increase in GDP level, okay, there's nothing is close to zero. Then you'll have a fiscal drag through the effect on long-term short rates and the dollar. There's be a crowding out of that growth. And to contain it, then they have to increase rapidly taxes on the household sector starting in 2024. So there'll be a massive drag starting then, but there'll be already fiscal drag in 2020. The economy is growing now 3 rather than 2, because this year and next year there's a fiscal stimulus. By 2020, that stimulus becomes a small fiscal drag, so not only going to go from 3 to 2, we're going to go below 2, we're going to go towards 1.8. So it's an artificial fiscal stimulus, unsustainable, peacetime, first time ever, during not a recession, and it's going to crowd out economic growth over time.
What does that mean for yields, Nouriel, Treasury yields?
Well, over time, the combination of U.S. monetary policy and the Fed tightening and this fiscal stimulus implies that long-term interest rates have gone higher and they're going to keep on going higher. Now, what keeps a lead right now on long-term trades in the U.S. is that while the Fed controls the short end of the yield curve, ECB, BOJ, and other central banks are controlling the long term of the yield curve, because there is still unconventional policies in other parts of the world. But guess what? The ECB decided we're going to finish QE and then start normalizing rate next year. Other central banks in Europe are going to do the same thing. Therefore, global liquidity is going to start to shrink. And therefore, once that happens and you still have the stimulus, U.S. long-term interest rates are going to tend to go higher. Short-terms are going higher. The dollar is going to strengthen. The current account deficit is going to become higher. And therefore, there'll be a crowding out by late next year of that economic recovery into a fiscal drag in 2020, into a tightening by the Fed towards 3.5%, and they have to go towards 3.5% because the fiscal stimulus leads to an overheating of the economy, and that tighter fiscal policy and tighter monetary policy could plunge the economy into a stall by 2020 if you add the trade frictions, the capital market frictions, the fact there'll be a slowdown in emerging market, in Europe, in China, and the fact that asset prices, as we know, are frothy. Profit and P ratios are 50% higher than the historical average. So when the market see the slowdown occurring into 2020, there'll be market correction that's going to have a negative wealth effect. So you might have by 2020 a perfect storm for the US and the global economy.
Okay, will the central bank have enough tools to deal with this perfect storm if we were to have it by 2020?
I think there are differences this time around, is that we are having policies that are stagflationary, that reduce growth but also increase inflation. For the last decade, all the shocks were stagflationary, meaning lower growth, lower inflation, and therefore central banks were doing even more and doubling down on more unconventional policies. But if you're going to have trade restriction, if you are going to have restriction to capital flows, if you're going to have restrictions to FDI and technology transfers, if you're going to have restriction to migration, if you're not going to invest into renewable resources, if you're not going to invest into infrastructure and there is no plan, all those shocks are stagflationary, are going to reduce growth, they're going to force inflation higher, and when that happens, when the economy is overheating, that's going to force the Fed to hike more faster and sooner rather than ease. As it happens whenever you've had a policy shock that has been stagflationary, like the oil shock 73, 79, 1990, because if you don't tighten, inflation expectations go higher and then you're in a worse situation. So the type of policy that is going to be followed by the US are going to imply forcing the Fed to have to tighten rather than ease, even if growth slows down, because inflation expectations are going to go higher. That's a difference in the ability and willingness of the Fed and other central banks to react to that economic slowdown that is driven by negative supply side shocks.
And that's the talk of every day, man. That's the talk of all the economists. That's the talk. While Jake is sitting around here worrying about things that don't pertain to salvation, you are not occupied in prophecies. You are not watching what's really going on, man. But these heathens, the red men, all they is focused on is their money, man. Okay? It's their money. And the economy is collapsing. So while they're focused on their money and what they're going to do because the economy is collapsing, you Jake's one about social media and Facebook, man, and Instagram. Going back to this.
I think Tony comes over. What do you think?
Why didn't you? I mean, you never asked. So you just have to ask. Every once in a while, Mel exerts kind of like I'm in charge kind of mentality and does what she wants to do. Good point. Which she should do, by the way. I brought paperwork. Wow.
Wow, very prepared, Tony. I like the style.
No, I gotta read you something, Mel. You're gonna love it.
Oh, you're gonna read it. I don't even get a question.
No,
I thought you did your little thing at the plaza.
I'm waiting.
Okay, so here's my question. If people believe that there's this rule of thumb that you have a certain amount of time after this, indicator flashes a recession signal, doesn't that time, the more people know about this lag time, doesn't that time period get compressed?
So it's a great question, and I went back and I read my prior notes because I want to make sure that I'm not full of it either. And in all those prior notes, every time
reading your notes, by the way, doesn't make you less full of it.
It may make you more,
but definitely more full of it. But the reason that I did that is to make sure that it isn't different this time, that I was saying the same thing back in the last cycle. And what creates that lead time is the 10-year note yield dropped so much. We've gone from 3.25 to in the 1.4 level.
Right.
That's extraordinarily stimulative because bank lending hasn't quite shut down yet. So there's still money moving around, and it just got really cheaper, and you're still at full employment. So you have this money that kind of surges into the market because that drop in the 10-year, and then it kind of shuts down, and the time it takes to put that money to work is what causes that lead time, but you get this little kind of bump in the economy. So you're like, maybe it is different this time, but it's not different this time.
In the past times, I'm curious also, where does that 10-year yield typically drop from, and does that make a difference? Because some could argue that a drop, and we've been sub 2 for a long time, even though we've been at more than 3, November of last year or so.
Yeah.
We've been sub 2 for so long that people could say that there was money being borrowed at those very low levels anyway, so every incremental drop in the 10-year doesn't lead to incremental borrowing on the part of corporations, which won't lead to incremental spending later on.
It does at the household level. There is no question, and Karen has brought this up a lot in the last couple of times I've been on. There's no question industrial spending and corporate spending has come down because of the trade war. That is not debatable. Household spending, however, is what is more sensitive to the drop in rates. So there's this idea in the marketplace that the lower risk premia and the global overseas negative yields has created this artificial suppression in the long end, which means that this may not be a good recession indicator. And what I brought to read is a quote, if you don't mind, Mel. Just listen to this for a sec. There's been a good bit of evidence that the declines in the term premium and perhaps a great deal of savings chasing a limited number of investment opportunities around the world have led to a somewhat permanent flattening or even inversion of the yield curve, and that pattern does not necessarily predict a slowing in the economy or recession. Ben Bernanke, February 2007. So that quote is saying the low global interest rates is creating demand for the U.S. product that's artificially suppressing the long end of the curve. So we've done this before. And
it didn't go very well, though.
It didn't go well. It was a much different cycle, but it didn't go very well, Tim, as you know.
Yeah.
So I'm curious, Tony, so if we're going to get this rip higher and the economy's going to look to improve, Stephen Grasso said today that people are buying chemicals, part of the cyclicals. Is that the best place to be?
In the earlier segment, you guys were talking about, Timmy was talking about how bonds came down and it's kind of surprising that stocks went up. Inflation break-evens actually upticked today. It was this morning when I think it became a pervasive story on the street that Bill Dudley came out with his op-ed on Bloomberg that suggested you don't want to have policy that allows for President Trump to win a second term. Now, nobody on the set or anywhere knows my political bias. That's not my job. But you have a former vice chairman of the Federal Reserve openly stating that the risk to the market or the risk to the economy is President Trump, and you don't want to pursue this policy because it might help him. That right there gave the Fed the flexibility to become aggressively accommodated, as I've been suggesting lately. Why? Because right now they have to prove that they're not kowtowing to President Trump. Now they have to prove on that op-ed, they have to prove that they're not biased against President Trump. They have to prove their independence, so you remove both tail risk. And now what can they follow? Their own inflation break-evens, which has 5-year forward inflation at 1.5%. They want 2%. If you don't do anything, how are you going to get 2% if it's at 1.5%? So that's what really I think is going to kickstart this rally that goes toward the peak. But a lot of people on the show, I've been a permeable. I've been.
Hey man, let me go back to this. Let me get these presets and close out. This is Psalms 64 and verse 7. But power shall shoot at them with an arrow. Suddenly shall they be wounded. So they shall make their own tongue to fall upon themselves. All that see them shall flee away. And this is what you got now, man. The Lord have shot at them with his arrow, and now they are wounded, and they're making their own tongue to fall upon themselves, man. These devils has a doomsday clock, man, which has been going on for a while. A lot of people might not know about it, but it's been going on for a while, man. They always had a doomsday clock. Now, I would say 24 months, 0 days, 7 hours, and 52 minutes, and 38 seconds. 24 months, man. Okay? Before a doomsday clock. Which is what? When they're going to, they offered the microchip, man. Making it mandatory. Collapsing the dollar, man. Okay, this is their clock. Why? Because they have an agenda, man. Since they came over here, they have had an agenda, man. And they got their time set when they're going to push their main agenda, which is to make the RFID microchip mandatory, man. Digital. One world currency, one world religion, new world order, man. So they're making their own tongue to fall upon themselves. Habakkuk chapter 2 and verse 6. Should not all these take up a parable against him, and a taunting proverb against him, and say, woe to him that increaseth that which is not his? How long? And to him that laden himself with thick clay. What's the thick clay? Debt, man. Debt. And it's nothing that they can wipe away. It ain't like they can't wipe it away, because they can. Because the elites, the Rothschilds, the Rockefellers, they control this, man. Okay, the Rothschilds in control of this, man. This is how they make their move. They make it seem like they tried to uphold it. They tried to keep the petrodollar. No, man. It's a game. Because they want everybody chipped like cattle, man. They want you branded with a mark. So it's a game. But they're making it seem like they go in steps. They do their agenda in steps, man. To deceive you. To fool you. Making you think something else, man. But the elites have an agenda, man. They have an agenda, man. The whole point of them is, over time, to crash the dollar so they can bring in a new currency. But Jay don't understand. Why? Because these devils then gave you the chicken sandwich. They done gave you PlayStations and Xboxes. They done gave you Facebook and Instagram. Okay? They done gave you all these different outlets, man, to keep you occupied. They done gave you all these TV shows, Love and Hip Hop and Atlanta Housewives and Basketball Housewives and all these different shows, okay? All the Black Ink and all these different Forged in the Fires and all these shows they got on TV, man. Okay? Constantly coming out with remakes after remakes after remakes of movies to keep you occupied, man. Okay? They done made the number one sport around the world. When you leave America, when you leave North America and go to the other countries, the number one sport is soccer. Now they have made soccer the number one sport in Babylon the Great, man. Keeping you occupied with sports, okay, and movies and entertainment, because what they did in the Roman Empire, man, when the dinar was collapsing, when the Roman Empire monetary system was collapsing, what did they do? They gave you coliseums, okay? They gave you theater. They kept you occupied with things of the world, man, so you wouldn't know that your economy around you was collapsing, man. And they doing the same thing to Jake today, man. They doing the same thing. And Jake have failed for it. Because we don't care about 2/3. We don't care about the heathen nations. This is for Israel, man. Trying to warn you Hebrew Israelites. You so-called Negro, Latino, Native Americans, man. But these devils have a plan, agenda, 21. Okay? 3-step agenda. They create the problem. The people react to the problem. And the people go to them for the solution. What's the solution? One world currency. One world religion. New world order. It's the Lord willing to edifying. Gotta give all praises, honor, and glory to Yahweh, Bahashim, Yahweh Shai, Bahashim, Rekah, Wadash. Double honors to the apostles and elders of Great Millstone who rule well, who teach well. And a sincere salutation to all the Akim, preaching the truth and believing its truth throughout the four ends of the earth, the entire world, waking up the hopeful elect. Shalom to the Akwa who are listening and learning. The few sisters who are listening and learning. Hey, Lord willing, till next time, Shalom.